Hello friends, this is Manoj Paprani. I welcome you all on behalf of the Edupedia world. So guys, we have already completed all the topics relating to the chapter Equity Analysis and Valuation. We covered each and every bit of equity analysis and each and every bit of equity valuation as well. Apart from that, we have also covered other security measures which were actually included in this particular topic itself. So, as promised to each one of you, I am here with the examination questions which have already been asked in CA final previous examinations. So, I do hope that you guys are enjoying your day to the fullest, and certainly you guys are all set for something which is being asked in CA final examinations. By now, we were just discussing and understanding the nuances and the topics relating to equity analysis and valuation. Now is the time when you'll get to know as to how and what kind of questions are usually asked for your CA final examination. We are all here for just one sole motive, first of all, and that will be your clearing of the CA final examination. So we'll have to take care of it first and the foremost thing. So are you guys all set? Perfect. With that kind of hope and belief, I want to just tell you, fasten up your seat belts. We are about to take off. Are you guys ready? Perfect. So let's start with the first question. This question was asked in CA final examination for November 2012. So let's first understand what this question says so that we can clear it in the best possible presentation and the best kind of thing which we can offer to the examiner so as to get the maximum number of marks. So following financial data for Platinum Limited are available. For the year 2011, rupees in lakhs. Equity share of rupees 10 each. Total number of amount is 100 lakh rupees. 8% debentures for 125 lakh. 10% bonds for 50 lakhs. Reserves and surplus for 200 lakh. Total asset will amount to rupees 500 lakhs. In this particular question, guys, you can simply see that the asset turnover ratio is 1.1. Okay, so we'll go step by step in order to make you understand it very clearly. So since the asset turnover ratio is 1.1, I can simply say that the turnover of this particular financial year will be 500 multiplied by 1.1. Since asset turnover ratio will simply mean turnover all divided by the total number of assets. So I can simply say that the turnover for this particular year would have been 550. Got that, guys? Perfect. That will be the first step in order to ensure that we start and begin our question in a very perfect manner. Next will come in as the effective tax rate, that is 30%. But before that, we'll have to take care of operating margin, which is given as 10% over here. So if in case the operating margin is 10%, the turnover which we decided was 550 lakhs. So in that case, the operating margin would be 55 lakh rupees. Got that? Perfect, guys. Next will come in as the required rate of return, that is 15%. Dividend payout ratio as 20%. Current market price for that particular share, one share, is rupees 13. We are supposed to draw the income statement for the year, number 1. Number 2 will come in as calculation of the sustainable growth rate. Number 3, compute the fair price of the company's share using dividend discount model. And the last one will be draw your opinion on investment in the company's share at the current price. So let's understand this question first of all, guys. Since the asset turnover ratio which has been provided to me in the question is 1.1 and the total number of assets is 500, I can simply say that the turnover will be 550. Next will come in as the operating margin. That will be my 10%. So 550 into 10%, that will come out to be 55 lakh rupees. Okay. From that, I'll have to deduct first of all the interest. You can see 8% debentures are available in the books as for rupees 125 lakh. Plus there is 10% bonds for rupees 50 lakhs. So I can simply multiply 8% into 125 lakhs and 10% into 50 lakhs. I'll get the interest as 15 lakhs. I got the operating margin as 55 lakhs. Out of the same, I'll be deducting the interest, which is likely to be paid on debentures and bonds as 15 lakhs. I'll get a profit before tax as 40 lakh rupees in that sense. 55 minus 15, that will come out to be 40. After the same, I'll be deducting the tax. So in this particular question, the tax rate has been provided to me as 30%. So 40 into 30% of that, that will come out to be 12 lakhs. So my profit after tax will be 40 minus 12, that will come out to be 28 lakhs. And since in this question, the first thing which has been provided to us is equity shares of rupees 10 each, and the amount of equity share capital is 100 lakh. So we can simply say that the total number of shares in this particular case will be 10 lakh. 10 lakh will be the number of shares. Since I got a profit after tax of 28 lakhs, I can simply say that the EPS will be 2.8. 28 lakhs divided by number of shares, that is rupees 10 lakh. So EPS will be 2.8 per share. And since in this particular question, dividend payout ratio has been provided to me as 20%. So I can simply say that the DPS will be 0.56. That is 2.8 into 20% of that. That will come out to be 0.56. So perfect guys, with this kind of information, our income statement is prepared. So let's head towards the solution now. So this is the picture of the solution. So I just told you regarding the same things. I'll just reiterate you all these things which you have actually solved it out over here. So sales and turnover as discussed, that was 550, 500 into 1.1. Operating margin, that is 10% for the same. That will come out to be 55 lakh rupees. After the same, we are going to subtract the interest of bonds and debentures, that will come out to be 15 lakh. PBT will come out as 40 lakh rupees. Out of the same, taxation will be deducted at the rate of 30%, that will come out to be 12 lakhs rupees. And finally, you will receive PAT, that is profit after tax, as 28 lakh rupees. The number of shares will be 100 lakh capital divided by 10 rupees basic value for per share. Number of share will come out to be 10 lakh rupees. I'll get the EPS, that is 28 divided by 10, that will come out to be 2.8. And finally, after the same, dividend will be provided at a rate of 20%, that will come out to be 0.56. So perfect guys, our first sub part is clear with that. So we have already prepared the income statement of the year, and that is this. Next comes in as the sustainable growth rate. So guys, next part is sustainable growth rate. So in any kind of a question, if I'll have to compute the sustainable growth rate, I'll have to remember one kind of concept. Growth basically happens on only that particular amount which has been retained. So if a company is earning 10 rupees and out of the same, entire 10 rupees is being provided as dividend. So is the company going to grow? Absolutely not. Because the company is not retaining anything with itself in order to ensure the further growth of the company. So growth basically happens only on the amount which has been retained. So sustainable growth rate will happen only on the amount which is retained over here. So the concept will comes in as return on equity into the amount which has been retained, or I should say the percentage of ratio which has been retained, that is called retention ratio. So in this particular case, if I'll have to compute the sustainable growth rate, I'll go with a kind of concept that is ROE into B. B means the retention ratio. So that will come out in a simply manner as PAT divided by equity. Equity is the amount which has been invested in any kind of business. Okay. And out of the same, I'm earning some kind of profit, which is PAT. So I can simply say my return on equity will be PAT whole divided by equity. Let's suppose I invested 100 rupees and out of the same, I earned 10 rupees. So I can simply say my return on equity will be 10%. So here, applying the similar kind of concept in this particular question, I can simply say PAT whole divided by sales into sales whole divided by assets into assets whole divided by equity. Finally, if you will get to know that the final summation will be PAT whole divided by equity itself, because the entire amount of sale and asset will be deducted automatically into B, that is the retention ratio, and that will come in as the PAT, which is 28 lakh rupees whole divided by the final 300, that was the equity in this particular case, into B, that is the retention ratio. You can simply say that the dividend payout ratio is 20%. So if in case the dividend payout ratio is 20%, so I am retaining 80% of the same, of the earnings basically. So my retention ratio will be 0.8 in that sense. That will come out to be the final thing, which is called sustainable growth rate, as 7.47. So here in this case, we have again got the sustainable growth rate as well, that is 7.47. Next comes in the fair price of the shares. So guys, in order to evaluate and compute the fair price of any kind of share, so we have got like different kind of models. In this particular question, we have been asked to provide them the fair price of the company's share using solely the dividend discount model. So the concept which particularly dividend discount model does provide you, that comes in as the dividend is being divided by the cost of capital, whatever the cost of capital is being mentioned in the particular question. And after the same, we subtract the growth rate first of all. So if in case the cost of capital for any kind of a company is 12%, we'll have to deduct the growth rate after the same. And for example sake, if that's 6%, so the final denominator will come out to be as 12 minus 6, that will come out to be like 6%. And numerator, that is the dividend, expected kind of dividend that we'll be receiving in next year, is usually taken as the numerator in that case. So that is the particular kind of a concept which usually dividend discount model does provide you. So that can be used with the formula, that is D1 whole divided by the cost of capital minus the growth rate. So in this particular case, we'll have to apply that same concept in order to evaluate the fair price of the company's share. That is the third thing which has been asked in this particular question. So the fair price for the share will be D1 divided by K minus G. So in this particular case, the D1 is 0.56, which has been evaluated as DPS at the rate of 20% of 2.8, which is 0.56, multiplied by 1.0747, that is the sustainable growth rate. So DPS is basically over here as the dividend which is received in this particular year. D1 is the dividend which is expected to be received in next year. Therefore, we have multiplied the same with 1.0747, that is the growth rate in this particular case. So 0.56 multiplied by 1.0747 whole divided by 0.15. Here in this particular case, it has been provided to us in the question as the required rate of return to be 15%. So required rate of return is being considered as KE in this particular case. So that will be 0.15 minus the growth, that is 0.0747. So the fair price of the particular share will come out to be rupees 8, which is far more less than what the market price is currently going on. The market price which has been mentioned in the question was rupees 13. So guys, in this particular case, I can simply say that the shares, if the same is being like held by the company, they need to be sold out immediately. Why? Because the shares are overvalued in the market. Let's suppose you're having an apple in your hand. Its fair market value is just 8 rupees. And the same apple is being currently sold in the market at rupees 13. So what's the best thing you can do? You can simply sell it off because you know its real worth is just rupees 8. And the same is getting sold in the market for rupees 13. That's the best time you can sell it off and quit the market. So same thing happens with shares as well. So since the shares are overvalued in the market, one should not buy them. It's better you can sell it off if you are already having them. So therefore, the share, if held, has to be sold. Since the shares are overvalued in the market, one should not buy them. So guys, that was the question which was asked in CA final examination for November 2012. I guess you got the complete understanding as to how to go about computing and solving this question in your CA final examination, if the same appears in yours as well. Perfect guys, with that kind of faith in you, let's move to our next question. This question was asked in CA final examination for May 2012. In December 2011, AB company shares were sold for Rs 146 per share. A long-term earnings growth rate of 7.5% is anticipated. AB company is expected to pay dividend of Rs 3.36 per share. First of all, we are supposed to find out what rate of return an investor can expect to earn, assuming that the dividends are expected to grow along earnings at 7.5% per year in perpetuity. Next, it is expected that AB company will earn about 10% on book equity. and shall retain 60% of the earnings. In this case, whether there would be any change in the growth rate or cost of equity. So, before going into solution, let's understand this question first. The solution will simplify your kind of understanding, but in order to make you understand the question, you'll have to first get the clarity of the same. So first of all, AB company's share was sold in this particular question for rupees 146 per share. Long-term earning growth rate is anticipated in this particular case, that is 7.5%. AB company is expected to pay the dividend for 3.36 per share. Okay, so we'll go one by one, the first part of the solvation of it in the first thing. So we are supposed to find out what kind of rate of return an investor can expect to earn, assuming the dividends are going to grow along with the earnings at 7.5% per year in perpetuity. So the case is pretty simple, guys. We'll be just applying the dividend discount model in order to compute the amount of rate of return. Whether an investor can expect this percentage or that percentage, we can simply use the dividend discount model to get the figure in that particular case. So we can simply say, using the dividend discount model, the cost of capital will be equals to dividend which is expected to be received in the next year, whole divided by the price, whatever the kind of price which is available currently, and we'll be adding to the same the growth rate in this particular case. I've just changed the format of the, so the kind of formula that I told you, the kind of concept that I told you in my last question, that was fair price of the share, will be equals to dividend as numerator, expected dividend as numerator, whole divided by KE minus E. So if in case I'll have to compute the KE in this particular case, so I'll just take KE plus G into LHS and price in RHS with the denominator part basically. So in this particular case, KE minus G equals to D1 whole divided by P0. So that will be the case in this particular case if I'll have to provide the derivation of this particular kind of concept. So KE minus G will be equal to D1 whole divided by P0. And finally, if I'll have to compute KE in this particular case, so I'll just move G from LHS into RHS. So KE will come out to be equals to D1 minus P0 plus the growth in this particular case. So herein, using the dividend discount model, we can simply find out the rate of return as K equals to D1 divided by P0 plus the growth. That will come out to be dividend in this particular question in as 3.36 per share, whole divided by the P0, that is the current market price that is available to us in the question as rupees 146. We'll be adding to the same the growth rate which is expected to be received until perpetuity, that is 0.075. That will come out to be as 9.8%. So guys, 9.8% is the basic rate of return an investor can expect to receive and earn, assuming that the dividends are expected to grow along with the earnings at 7.5% per year in perpetuity. So that's 9.8%. The next part, it is expected that AB company will earn about 10% on book equity and shall retain 60% of the earnings. In this case, whether there would be any change in growth rate and cost of equity or not. So we'll have to perform the basic further analysis in second point as well. So guys, since we have been told that the return on equity is 10% in this particular subpart and the retention ratio is 60% of the earnings, I can simply say that the growth will happen in only and only on that 60%. Why? Because 40% is directly distributed amongst the shareholder as dividend. So we can expect the growth to happen only on the amount which has been retained. So that is 60% of the earnings. So in this particular case, the growth will be retention ratio into ROE. So that will come out to be 6%. Why? Because you are basically having a retention ratio of 0.6 over here. That is 60% of the earnings. And you can earn 10% on that as book equity. So that will come out to be 6% in this particular case. So if in case the growth is 6%, return on equity is 10%, retention ratio is 60%. So I can finally compute the cost of capital as dividend 1, that is 3.36, which is being provided in the question, divided by P0, that is 146, plus the growth rate, which we just computed in as 0.06%. So that will come out to be rough about 8.2, 8.3%, I guess. So yes, if return on equity is 10% and retention ratio is 60%, then G is equals to B into ROE as 6%. That will be the growth. And therefore, I can say that the K will be equal to D1 divided by P0 plus the growth rate, that is 3.36 whole divided by 146 plus the growth rate, that is 0.06. That will come out to be 8.3% exactly. So guys, this way you can go about solving any kind of question in your CA final examination. Just get your concepts clear, get the utmost kind of clarity with each and every kind of concept, and definitely you won't face any kind of trouble during your examination. Don't go for any kind of verification of the formula or something. Let's understand the concept first of all, and the solutions will be like easily solved in either way around. So perfect guys, that was the question which was asked in CA final examination for May 2012. Let's move to our next question. This question was asked in CA final examination for November 2009 and May 2011. A share of Tension-Free Economy Limited is currently quoted at a price earning ratio of 7.5 times. So P has been provided to us as 7.5. The retained earning per share being 37.5% is rupees 3 per share. So again, retained EPS has been provided to us being 37.5% as rupees 3. So I can say that if rupees 3 is being retained, which is 37.5%, so the remaining 62.5% has been distributed as dividend, which will be rupees 5. If you will take care 37.5% as 3, so 62.5% will come out to be rupees 5. So we are supposed to compute the company's cost of equity if the investors expect an annual growth rate of 12%. Second, if the anticipated growth rate is 13%, calculate the indicated market price with the same cost of capital. And the third will come in as if the company's cost of capital is 18% and anticipated growth rate is 15%, then we are supposed to calculate the market price per share assuming other conditions will remain the same. So perfect guys, before moving into conclusion and the solution for this particular question, we'll be understanding it rough about. Understanding the question will be the first thing which has to be done so that you can perform the solution well by yourself. So we'll understand the question first. So in this particular case, the PE ratio has been provided to us as 7.5. The retained earnings per share being 37.5% is rupees 3. So if retained earnings is 37.5%, 62.5% is being distributed as dividend. And if 37.5% being rupees 3 is kept as a retained earning, so in that case 62.5% will come out to be rupees 5 per share, which is being distributed as the dividend. So I can say that the company was able to earn rupees 8 in totality. Out of the same, 3 is being retained and rupees 5 has been distributed as dividend. So if in case we'll go about taking care of the EPS in such a case, which has been provided to us as rupees 8 in totality, okay, and PE ratio has been provided to us as 7.5 times. Will it be like difficult for me to get the price? Absolutely not. So PE has been provided to me as 7.5 times. I've got the EPS, that is 3 plus 5 rupees 8. So I can simply say price will be equal to 7.5 into 8 rupees, and that will come as rupees 60. So the price will be rupees 60 in this particular case. And if in case I'll have to solve the first part, which tells me that the company's cost of equity has to be computed if the investors expect an annual growth rate of 12%. So the dividend which was provided in this particular year was rupees 5. So I'll be directly multiplying the same with 1.12, which will be the dividend expected to be received in next year. So 5 into 1.12 will come in as 5.60. So 5.60 is going to be my expected dividend to be received in next year. That is D1. So now if I'll have to compute the cost of equity, I'll simply apply the kind of formula, the kind of concept which we got in my last two questions, which was dividend discount model. So K will be equals to D1 divided by P0 plus D. Here in this first part, my D1 will be 5.60 whole divided by my P0, which is my current present market price, which we just computed in as 60 rupees. Plus, I'll be adding to them the growth rate, that is 0.12. That will come in as 21.33%. So let's move towards the solution in order to understand whether we are understanding the things on the same lines. Perfect. Let's go for it. So the price of the share as per the dividend discount model will come in as D1 whole divided by K minus G. Retained earning EPS was rupees 3, 37.5%. Dividend was provided at 62.5% of the same. So the dividend will come out to be rupees 5 in this case. Price upon EPS, that is PE ratio, was 7.5. Therefore, price will be 7.5 into rupees 8 in totality, 3 plus 5. I'll get the price in as 60 rupees. Again, the D1 will be 5 into 1.12. That will come in as 5.6. And therefore, D1 whole divided by P plus G, that will come out to be 0.0933 plus 0.12. In totality, that will come out to be 21.33%. So my cost of equity in this particular case will be 21.33%. Perfect, guys. I hope you got the first part exactly with the same kind of clarity as to what I was delivering you before providing you the solution. So that makes you understand the concept very well. So try and make a habit in your mind, in your regular kind of life. Whenever you are trying to solve any kind of question, don't ever look at the solution first. Always try to understand the question first of all. What the question is likely to deliver you in the forms of bits and pieces. Try to rearrange them accordingly. And that way you'll be able to understand and develop that kind of understanding of solving any kind of question. So that will help you in making you analyze things in a far more better way by what you can do it by simply looking at the solution. So always go for that kind of option first of all. Only then, if in case you are not able to quantify or compute any of the solutions in your own manner, then only you should look out for any kind of answers or solutions. Before that, always do and try to solve the question by yourself first of all before looking out into solution. Next subpart was if the anticipated growth rate is basically 13%, then we are supposed to calculate the indicated market price with the same kind of cost of capital. Okay. So there is just a single and a mere change of growth rate. In this particular case, the growth rate was 12%. In the next subpart, that has been provided to us at 13%. So if in case that's 13%, I can simply say my D1 will be changed. So in this particular case, my D1 was 5 into 1.12. So in next subpart, that will be 5 into 1.13. So that will come out to be 5.65. Growth rate will come in as 13%. K will remain same, has been provided in the question as 21.33% with the same one. D1 will be 5.65. So if in case I'll be applying all these three things, I'll get the P as this particular stuff. So G will be 13%, K will remain same, 21.33%. D1 will become 5.65 from 5.62. So P will be 5.65 whole divided by KE minus G, that will be 0.2133 minus 0.13. So the price of the share will come out to be rupees 67.83. So guys, that was the second subpart of this question. Next comes in, if the company's cost of capital is 18% and the anticipated growth rate is 15% per annum, calculate the market price per share assuming all other conditions will remain the same. So now in this particular third subpart, we have been told that the company's cost of capital will be 18%. So K will be 18% and the anticipated growth rate is 15%. So G is 15%. So now since G has been provided to us as 15%, now D1 is again going to change. So D1 will be 5 into 1.15. That will come out to be 5.75. So we are again supposed to find out the price if in case these three particulars have been changed. So if G is 15%, K is 18%, so D1 will be 5.75. That will be 5 into 1.15. So we are supposed to find out the price in that case. Price will be 5.75 whole divided by 0.18 minus 0.15. That will come out to be rupees 191.67. So perfect guys, that was the question which was asked in 2 of the CA final examination. This question has been asked twice, November 2009 and May 2011. I guess you got the complete clarity and understanding how to go about solving this question in your CA final examination. Perfect guys, with that kind of hope and belief, I will just move to our last question for this following presentation. This question was asked in CA final examination for May 2013. What does it say? Let's understand that first of all. ABC Limited is considering acquisition of DEF Limited, which has 3.10 crore shares issued and outstanding. The market price per share is rupees 4,40,000 at present. ABC Limited's average cost of capital is 12%. The cash inflows of DEF Limited for the next 3 years are as under. So we have been provided in this particular case 3 years cash flows. So for year 1, that will be 4,60,000 crores. For year 2, that will be 6 lakh crores. And for year 3, that will come out to be 7,40,000 crores. We have been provided and we are required to calculate a range of valuation that ABC Limited should consider while going for the acquisition. So we are supposed to provide them the range within which ABC Limited can decide and consider to acquire DEF Limited. So we have been provided the present value interest rate factor for 12% for number of years as 3, in as 0.893, 0.797 and finally 0.712 in the question itself. So we'll go about taking care of the same. So again, we'll understand the question first of all and get the solution ourselves without looking at the solution first. I am actually going to make this habit into your mind, imbibe that kind of habitual thing in you. So by default, you start programming your questions within yourself first, then only you look out at the solutions. So I'll program you accordingly in that way. So in this particular case, we have been told that the number of shares is 3.10 crore. Okay, and the market price of a single share is 4,40,000. So first of all, I can see that the market capitalization of DEF Limited should be 440 into 3.10 crores. So that will come out as rupees rough about 1,300 crore something. That will come out to be about this much. And if I talk to you regarding the same thing for the valuation, so their current market capitalization is around 1,300 crores. Okay, and if I'll have to compute the value, the fair market value of them, so I'll go about taking care of their cash flows first of all. So if in case in first year I'll be generating a cash flow of 4,60,000. Okay, so if the same is being divided by 1.12, that is the particular KE of first year, so I'll get the value for present value of cash flows that I'll be receiving after a year, and that will come out to be 460 whole divided by 1.12. Again, in the similar notion, I'll be taking for cash flow of year 2, that will come out to be 600,000 crores. So the same will be divided and with the denominator of the same thing as 1.12 whole divided by square. So whole square basically. So herein I'll get the amount of cash flow, the valuation, present value of the cash flow that I'll be receiving after year 2. And on the same note, again, I'll be applying the same principle for year 3 as well. That will be 740, that is 740,000 crores divided by 1.12 to the power 3 now, because that will be the third year. So I'll get the present value which I'll be receiving after 3 years. The present value will be obtained for the same amount as today itself. So accordingly, I'll get the value of the shares in accordance with using the principle of applying present value of the cash flow. That will also provide me some kind of a range. So my capitalization will be one range. The value which I'll be receiving out of the shares will be another range. So I'll be purchasing or acquiring DEF Limited within that kind of range. So let's understand this solution now. The simple present value of the future cash inflows, ignoring any kind of future perpetual growth of DEF Limited, will be valuation of the particular shares will be CF, that is the cash flow which is likely to be received after 1 year, whole divided by 1 plus K, plus the cash flow which is likely to be received in the second year, whole divided by 1 plus K to the power 2. And finally, cash flow which is likely to be received in third year, whole divided by 1 plus K to the power 3. So that will come in as 460 divided by 1.12 plus 600 whole divided by 1.12 to the power 2. Why? Because that will be received after 2 years. And finally, 740 whole divided by 1.12 to the power 3. Why? Because the same will be received after third year. So the present value of that cash flow will be rupees 1416 crore approximately. And since we did discuss about this fact that the shares of DEF Limited are quoted at rupees 440 and it has 3.10 crore shares, I can simply say that the market value will be 440 into 3.10 crore, that will come out to be rupees 1364 crores. So guys, this particular thing will provide you the kind of range wherein you can think about acquiring or purchasing DEF accordingly. So the minimum price that DEF is going to accept for themselves will be 1364 crores, and the maximum price that you can think about like providing the same to DEF Limited shareholder will be 1416 crore. Why? You will be like able to extract the benefit that till 1416 crores. So you have provided the maximum kind of benchmark, that is 1416 crores, and DEF is going to negotiate on the minimum front, that will be 1364 crores. So you'll have to amplify both the things accordingly. That therefore ABC Limited can have the range of valuation of rupees 1364 crores and 1416 crores for acquiring the DEF Limited. So guys, this question was asked in CA final examination for May 2013. I guess you got the complete understanding for how to go about taking care of valuation, wherein you can be like easily solving the same thing whenever you encounter such stuff in your CA final examination. So perfect guide. I hope I was able to provide you the entire group of clarity. I'll be sharing more questions with you in my forthcoming presentations. That's just not the end. Mere 4 questions are definitely are going to help you out a bit, but not entirely. I know that kind of fact, and certainly I'm going to share many more presentations for that stuff as well, wherein I'll be like sharing with you more kind of examination questions in order to make you understand the concepts completely. So stay relieved at that kind of fact. Definitely I'll be taking care of it very well. So perfect. With that kind of sharing, I'll be ending my video. My conclusion will be with a dose of motivation, and that will be, do you want to know who you are? Don't ask, just act. Action will delineate and define you. This quote was being mentioned by Thomas Jefferson. So a very nice kind of a quote he has mentioned over here. Most of the people in our respective lives are like running here and there without any kind of purpose in their mission. They are not having any kind of vision for their respective lives. So, and out of the same stock, there are many people who are just pondering with the kind of belief, okay, they are going to find out the purpose someday. They are just basically finding themselves that who they are. So if you want to know, do you want to know that who you are? Please don't ask that. Okay. Start taking actions in your life. If you feel like that you are good at something, okay, then don't waste your time like pondering about any other fact. Just go and do it once and for all. Because that is the best thing that you can have for yourself. You just thought for an idea, think about it, ponder about it, and just take the action. Don't delay it in any kind of form, because delaying is definitely going to postpone the things for a long while, and there are chances that someday you are not going to do it at all. So just act. Action will delineate and define you. So certainly that should be the case in each and every person's life. We are supposed to find out our purpose, and we are supposed to take actions on that. Finding the purpose and taking no action for it will be like nothing for anybody. So always strive for taking actions in your life. That should be positive actions. No matter whatsoever society is talking about you, whatso your parents, your family, or anything is saying about you. If you have something in your mind, and if you have the complete faith in it, believe me guys, just do it. Just do it. And that way you are going to prove every person in your world that yes, you were right. You were right initially on your thoughts, and definitely you can take care of it very well. So perfect guys, with that kind of positive transformation, positive motivation, I'll be like thanking you on behalf of the Edupedia world. Keep interacting via questions, queries that will help us in understanding your needs way better, and certainly that will inspire us and motivate us in providing you the best of the concept clarity as well. So stay connected. Perfect guys, with that kind of open belief, I'll just move forward towards my other things and other presentations as well. So perfect. See you in the next presentation. God bless you guys. Love you all. Take care. Bye.